good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're taking a look, after all of the budget debate and budget conversations, at financial results once again, and in particular, we are looking at two of the more significant banking franchises listed on the Trinidad and Tobago Stock Exchange, and we're talking about FirstCaribbean International as well as Scotiabank for the 9-month periods ended July 31st, 2020. Now, both companies would have reported lower earnings on the back of reduced revenues, as well as some increased provisioning for impairments in the coming months ahead. So let's go straight to Scotia, and for that 9-month period ended 2020, Scotiabank would have reported an earnings per share of $2.08, which was a 30% decline from the $2.97 recorded in the prior comparable period. Now, net interest income was down just around 0.3%, so in terms of loans, the interest income being generated has been fairly stable. Overall, total revenues were down just around 4.3%. Non-interest expenses, however, did increase just around 3.4% from 563 to 582 odd million, probably because of, or very likely because of, increased expenses associated with COVID. The main driver, however, was that increase in net impairment losses on financial assets, which almost doubled from $107.8 to $210 million. Overall income after taxes increased, or decreased rather, from $523 to $366 million. So that's the 30.1% decline. As you can see, in terms of revenue composition and revenue growth, well, over the past 4 comparable periods, Scotiabank was increasing their revenue, albeit at a decreasing pace, from 11% all the way down to just a 1% marginal growth in the 9 months of 2019. However, 2019 over 2020, that would have reduced to that 4% decline in overall revenues, as we would have mentioned, and certainly a reflection of what's going on in the local economy and the overall reduced activity being faced by banks as well as the wider economy. So at a price of $55, Scotiabank is trading at a price-earnings ratio of 19 times, which is pretty much in line with the banking sector average of 18.5 times when excluding the price-earnings ratio of FirstCaribbean International Bank. The group continues to pay fairly consistent dividend payments, although their most recent dividend was decreased by just around 20% from 50 cents to 40 cents. And on the basis of that, as well as challenging adverse economic conditions for the foreseeable future, Bourse maintains its neutral rating on Scotiabank. Turning quickly to FirstCaribbean, and for the similar comparable period of the 9 months of 2020 ended July, FCI would have reported a loss per share of just around 19 cents, which compares quite unfavorably with the 50 cents per share reported in the prior comparable period. Now, in similar fashion to Scotia, total revenues for FirstCaribbean International, or FCI, was down just around 5% from 3.08 billion TT equivalent to 2.9 billion TT equivalent. Operating expenses, in similar fashion, would have remained fairly stable, up actually just around 0.8% from 2 billion to 2.025 billion. And the major driver, again, would have been that very sharp increase in credit loss expenses on financial assets, which would have swung from a near zero level in the first 9 months of 2019 to 850.9 million TT equivalent in the first 9 months of 2020. There was also a write-off in terms of goodwill for impairment of intangible assets, and again, that's related to goodwill. So overall, the net loss attributable to income, or to equity holders rather, was 291.9 million TT equivalent. When we take a look at profit before taxes by segment, we can see some fairly significant changes. A very sharp decline in the corporate and investment banking segment from 644 million TT equivalent to 372 million. Wealth management was relatively stable under the circumstances, but the major deteriorations in values of portfolios being managed would have led to declines in wealth management fees. And retail and business banking would have swung from a profit of 285 million for the 9-month period of 2019 to a loss of 207 million for 2020, the 9-month period. So at a price of $7.05, FirstCaribbean is trading at a very lofty price-earnings ratio of 521.5 times, which, when included with the banking sector average, takes that average to 119 times. But again, very significant changes to earnings, or losses rather, would have skewed those particular ratios. and is trading at a dividend yield of 4.8%. So on the basis of adverse economic conditions, again, a potentially prolonged economic recovery, which will be faced by FirstCaribbean as well as pretty much every other listed stock, but paying their dividends in US dollars, Bourse maintains its neutral rating on FCI. Well, that's it for this week's edition. For more information, you can give us a call at 226-8773, email us at invest@boursefinancial.com, or you can check out all of our research on bourseinvestment.com, as well as today's Guardian in the business section. Have yourselves a great investing week ahead. This has been the Bourse Report.